Thank you for joining us today. We're going to talk about what makes a multi-class BDC unique. Today, I will be joining you along with Kristen Burns, as well as Sean Connor, who's with Blue Owl Securities, and James Jeske, who's a managing director at State Street Alternatives. Sean, maybe give us a little bit of your background. I think you've been in this area for about 10 years.
Yeah, thank you, Cynthia and Kristen, and great to be with you two and James. I'm a managing director at Blue Owl Securities. Blue Owl, just for background, is about 62 billion assets under management, half of which is under what we call the Dial business, and the other half is Owl Rock, which is our direct lending platform. And the vast majority of that sort of 31 billion is in BDCs. So we have 5 BDCs, 2 of which are non-traded, one's public and one's private. So I've been at Owl Rock since day one, and we've built a pretty large BDC platform. And then before that, I've been in the non-traded BDC space for sort of another 5 years. So I've been in the non-traded BDC space now for a little over a decade, which I think makes me among, unfortunately, the oldest in the space. But it's been certainly an interesting space, and one that's growing and quite dynamic.
Great. James?
Yeah, hi everyone. James Jeske from State Street Alternatives. I'm focused on private credit and private equity here at State Street. And as far as the BDC community, we've provided support to BDCs and client sponsoring BDCs for 10 years now, offering administration and accounting, custody, and transfer agency. As of 6/30, we're excited to support over 25 BDCs and $80 billion in AUM across the book.
Fantastic. So we've got a huge amount of experience on the phone. So just to talk or to lay the underlying information, the BDC non-traded structure really got started as a result of mirroring somewhat the REIT structure, the REIT non-traded. And in 2008, Franklin Square actually started off the first non-traded entity. And then there was quite a bit of interest over the course of the next couple of years. And it reached its height in 2014, about 5.5 billion. And then there was somewhat of a waning of interest for a number of different reasons. But today you've got about 16 non-traded BDCs with 23 billion under management. And one of the reasons that we're talking about this today is that the multi-class relief that a number of BDCs had been waiting for a long time, or platforms have been waiting for a long time, which mutual funds and closed-end funds could do. BDCs had not gotten that relief, and I had been waiting almost since about around 2008 to do that. And so in February of 2020, the SEC granted the first relief, and now there's at least 3 or 4 folks who've gotten relief, and then a number of others in the pipeline. And so now the multi-class structure can be used. All of a sudden, there's a renewed interest. And the multi-class structure allows basically the BDCs to offer into multiple channels at different commissions and expense rates. But in order to do that, you have to have an order. And we're going to talk through some of the intricacies of the order, and then and some of the issues that those conditions create for the BDCs and some of the opportunities. So Sean, I just wanted to ask you a question first. You know, why is it so important to in a non-traded structure to have a multi-class product?
Yeah, so I think you hit on it in your comments, but I just want to underscore it. It's really around flexibility. And so I would sort of reverse the question. Almost every other product you can think about from a structure perspective, whether it's a private fund, a REIT, a mutual fund, an interval fund, offers some level, or used to offer some level of customization that you just could not do in terms of differing compensation to financial advisors, lowering that compensation for institutional investors. And so the ability to offer multiple share classes essentially puts you on par with the mutual funds, REITs, and all of the other products that folks are familiar with. So if anything, I think this is more of just a leveling, bringing BDCs up to the 21st century, as opposed to something, you know, like overly dramatic or innovative. It just it was sort of a long time coming to bring it on par with other structures. And by being on par, you know, you can see that customization just sort of flourish, and folks can use the different share classes in different ways.
Right, and maybe you can go into a little more detail just describing what those different channels are that you can access, and just walk through those with folks who may not be as familiar.
Yeah, so if you look at sort of non-traded BDC, 1.0 going back to 08, you basically had you had one share class, which had a big, had an upfront sales load, and that was really it. And you couldn't customize. Today, you've got various share classes, different upfront sales load, different trail fees. And basically what you can do, it opens up all the markets. So historically, the non-tradeds were sold into the independent broker-dealer space. Today, they're sold essentially everywhere. We have significant institutional investor interest. We see it from the wirehouses. We see it from family offices, RIAs, independent broker-dealers, and it speaks to what that customization allows for. Every client has a different need or a different view, and having a share class that meets that need or view is important, whether it's a BDC or any other product. And so, now BDCs are seeing adoption pick up because of that ability to really broaden the distribution capabilities within the universe.
And maybe Sean, one more before I go on, is how do you decide what the fee is going to be? How does the market dictate that? Does the channel dictate that? How do you decide?
Yeah, so in terms of like the cost of distribution that get added to the share classes, whether it's the upfront or the ongoing trail, it's very much market driven and client driven. So the beauty for us as BDC managers is that there's a long history of products that have varying upfront sales load and varying servicing fees. And so you look to that. So whether it's the REITs or the mutual funds or the interval funds, and the market will tell you what they think is an appropriate level of compensation. That's both, there's a commercial element of that, just making it the right price, but then there's also the regulatory element to make sure it fits within the various constructs of the platforms. There's a whole bunch of sort of FINRA regulation out there that folks want to make sure that the compensation is fair and equal across platforms. So it's not something we can just pick and just run with it. You have to build it collaboratively with your partners to make sure it fits their commercial and regulatory needs.
Right. So to the extent you get this relief, you could do upfront fees, you can do deferred fees, you can do servicing fees, and you just have to make sure that all dovetails with the channel you're addressing.
Exactly. You just need to make sure that typically you get the flexibility, and then you build the product with the clients to make sure it fits their needs.
Great. So Kristen, can you talk through some of the relief that's required?
Sure. So Section 18 of the 1940 Act prohibits BDCs from issuing multiple classes of stock, and a class is defined, or a class is separate if it receives different allocations of fees and expenses, or if it has unequal voting rights. So what we're talking about here would definitely be a class and would require exemptive relief. And then the exemptive relief has three main requirements, which are implementing a written shareholder servicing plan and complying with Rule 12b-1, adopting a multi-class plan that complies with Rule 18F3, and complying with FINRA Rule 2310. Without going into too much detail, Rule 12b-1 governs the use of fund assets that can be used for distribution and shareholder servicing related expenses. As a result, the ongoing servicing fees that Sean mentioned must be covered by a written plan that must be approved by the shareholders and the board initially, and then annually thereafter by the board. And there are also a number of corporate governance requirements associated with such a plan, including that the independent directors nominate other independent directors. There are requirements with respect to independent counsel. The board has to evaluate itself and its committees periodically and meet at least quarterly in executive session. Rule 18F3 governs the multiple classes, and it requires the BDC to adopt a multi-class plan, which sets out the general conditions of each share class. And again, this has to be approved initially by the directors, and then again, anytime there are material amendments. And the plan must provide that there are separate arrangements for distribution and shareholder services fees, and that each class pays the expenses of such arrangement, that each class has exclusive voting rights if there was a matter that affected that given that particular class more than others, and that otherwise the class is the same as all of the other classes. FINRA Rule 2310 caps organ offering expenses at 15% of gross proceeds, and then provides that all other items of compensation be capped at 10% of gross proceeds. And then there's sort of another laundry list of conditions in the exemptive relief that relate to the ability to charge a deferred sales load, require compliance with Rule 22D1, which requires that variations in sales load be applied consistently and be adequately disclosed, and imposes conditions on certain fees that may be charged if the BDC were to acquire its own securities or exchange them in an exchange offer.
So this is, there's quite a bit of structuring that I think is going to go on here. So we've got Sean's piece, which is really kind of the client-driven or the channel-driven. Then you've got the requirements of the exemptive relief that are somewhat new for BDCs. And then you've got to actually take in the money from the clients and get it organized and audited. And that's where James comes in. James, maybe if you could talk about how you get a product like this up and running.
Yeah, sure, Cynthia. And to your points and what Kristen just went through, it doesn't happen overnight, right? So there's a lot of steps in the process, a lot of things that need to be tracked and checked across multiple constituents in the market. So it's not just, the BDC investment manager and the transfer agent. There's multiple parties out there that they'll be working with, of course, with counsel throughout the process. So setting the pipes up, if you will, takes some time, because in our experience, each of those distribution channels and classes not only require separate and distinct calculations to be tracked, but it's a different channel for investors to come through and separate connectivity that's required with each of those channels. And the other thing to keep in mind here, and I think it probably goes without saying, but the name of the game here is volume, right? So creating a platform that we're not talking about 1, 2, 5 large institutional investors. It's really building processes across all those steps that are built at, to handle tremendous scale. So it's really thinking about it. It's months leading up to the launch of one of these, setting up those pipes appropriately. And then in most cases, we've seen each class really be its own distinct work plan to make sure that, things are tracked, captured appropriately for that independent class and how it may differ from the one before it or after it.
Great. And then in addition to that, you've got the board requirements, right? Kristen walked through that. So once you pull together the registration, the exemptive app, all the pipes, as you just mentioned, you're well into this by several months. And unlike an IPO, you're going to do a continuous offering, so you got to go effective first. And we're not even going to address the whole state issue that's out there. So there's quite a bit of things that need to be dovetailed together. And one of them is getting your board of directors up to speed. This is a new area for BDCs. So a normal BDC board would not have a lot of education behind, as Kristen mentioned, the multi-class plan. And that plan needs to talk about the characteristics, needs to talk about how you're going to calculate the NAV, which class, which channel you're addressing by each class, whether you can have additional classes. It needs to go through all of that detail, and the board's got to go through that. So just explaining how that's going to be put together, how it's going to appear in the prospectus, and then how you're going to monitor it on a going forward basis. And then you've got a 12B1 plan, which again was not something that a BDC board would normally have looked at, and you've got to have both board approval and shareholder approval for that, but you can do that at the outset of a new product. But that 12B1 plan, the SEC is very specific about how you can use that. It's a servicing fee. That's the piece that you can add in if you've got that type of plan in place. But the SEC is very concerned about protecting the funds within the portfolio. And so whenever you're taking funds out, the SEC wants to have some, understanding, or the board have an understanding about how that was going to happen. So they've got to the board's got to make a decision that it benefits the fund to pay those servicing charges. And it's a reasonable business judgment standard, or reasonable person standard, which is consistent with how the board determines everything else. But it's one of those things you have to spend some time on, similar to a 15C type process. And then as you go forward, you have to, the board on a quarterly basis, they have to look at how the fees are being calculated, what's coming in, how the servicing fees being charged with the various classes. And then on an annual basis, it's got to relook at the plan and make sure it is still benefiting the fund. So it's and you have to have some comparative data, which, as we already mentioned, there's not a lot of BDCs out there doing multi-class plans. So getting comparative data is still, you've got to use other areas by analogy, at least during the time being, unlike a mutual fund, which would have, all types of indexes and comparisons to look to. So you have to spend a fair bit of time with your board of directors explaining all of this, explaining how it's going to operate, and you have to take into account any changes in the market. So it's a process that you've got to go through. And then maybe back to the talking about the actual broker-dealer networks and where you're raising the money. Sean, what is the independent broker-dealer network, and how do you work with that channel, and how do you build up relationships?
Yeah, so if you look at sort of the private wealth marketplace where most of the non-traded BDC capital is being raised, it's broken down sort of, the wirehouses, the independent broker dealers, and then sort of the RIAs and the family offices is kind of the three distinct groups. The non-traded BDCs have historically been most purchased and most interested by the independent broker dealers, although the wires and the RIAs and family offices are now increasingly focused with these new share classes. But they all generally have the same approach, which is you need to have a pretty sizable team with very deep relationships that can educate their decision makers on the research side of what the product is, how it works, how it fits within their clients' portfolios, the value it can add, et cetera. And that is really way more than months. I mean, it is a very long, relationship-driven, having to sort of know them and explain to them not only the strategy, but then the structure and how those two kind of fit together. Then you need the team to build those pipes, as James mentioned. Those pipes, it's typically it's not just between us as a fund manager and our partners at State Street. It also includes our partners on the distribution side. So it's really a three-way sort of build. You need people to do that, and those are resources that you have to build, and then you have to go out and raise the money, and that takes people as well who can articulate the structure of the fund, how it works, as well as the strategy itself, and then service those clients. So it's all that to say you need a very large team. It's not easy. It's not cheap. It takes quite a long time to build it, which is why, James hit up, but just to underscore it, these products really have a lot of merits, but they need scale to work. And so, you need a scaled team to do it. And it's quite a laborious, process. And that's after you've already gotten through all the regulatory pieces, getting exemptive relief, working through the states, getting the fund effective. There's a whole other layer of work to be done just to get the product onboarded. Then there's a whole layer of work to be done to distribute the product. And then there's a whole layer of work to service where you distributed the product. So it takes quite a lot of effort.
So are you seeing these channels are opening up to the multi-class BDCs? Is it something that their clients are interested in? And to some extent, this is allowing them the underlying client to participate in an area they might not otherwise be. Is that what you're seeing? Absolutely.
So we have one of the first multi-share class BDCs. There's really not that many out there that are active. I think there's just two. And we've seen adoption in places where we haven't seen it almost immediately. But it's the byproduct of 5-6 years worth of discussions and work with it. And so we're certainly seeing it, and it's, the strategy made sense. I mean, most BDCs are credit driven, not all, but most are credit driven and income driven. And so you think about just today, a low yield environment, these products offer you access to a strategy that really makes sense to a lot of folks in an otherwise low yield environment. And now it's in a way that, is more palatable. The share class makes more sense to them. It fits their needs. And so having that flexibility to tailor the point of entry for each individual investor, coupled with just the overall market environment has driven adoption.
Kristen, you want to talk a little bit about how it ramps up?
Yeah, so it sounds to me like the combination of the broker-dealer diligence and relationship building process, the exemptive relief process, and then Cynthia alluded to the state blue sky process, that all could take a long time and result in a potentially longer ramp period for a multi-class product than a regular BDC. Sean, do you and James want to talk to us a little bit about some of the ways that you guys have seen folks work through this longer period? For example, are you more likely to consider a formation transaction or rely on seed capital, or possibly offer one class of shares initially while you wait for the exemptive relief to come through?
Yeah, I'm happy to give my perspective, and James should weigh in. I think all of them have been used at some point over time. Increasingly, again, it comes back to scale. I think increasingly using seed capital, unless you're going to show up with a big amount of seed capital, is going to be difficult. And so I think you're going to see a trend of either formation or some form of warehousing of investments. Something where you can bring scale. Again, it all comes back to scale. At this point in the market, people are worried that these products are very hard to ramp, and you have a big chicken or egg problem. And that's, once you've gotten through the registration process. So I think you'll see a combination of sort of formation transactions, seed capital, warehousing, and maybe all three all in once. I think just kind of, historically, these non-traded products going back, 8, 9, 10 years ago, you just started at zero and slowly ramped your way up. I don't think that is a feasible model anymore. You have to show up with some measure of scale day one, and you have to sort of beg, borrow, and steal your way to get to that scale through all of those strategies. And maybe there's others that we haven't thought about here, but I think we're seeing some of it now, but I think you're going to see more of it in the future, because it's become table stakes increasingly in the marketplace if you don't show up with a couple $100 million or more.
So, James, if a potentially future multi-class BDC were to commence operations with only one share class, can you talk to us about some of the operational considerations that would give rise to?
Yeah, so just to build off of what Sean was saying, I mean, first of all, that's young. The multi-class BDC structure is young. So, our perspective is only, is currently emerging, right, as the market unfolds. And I think as far as the conditions that he mentioned, there's not only the working with the different channels, but it's also just a matter sort of a portfolio management conditions that need to be met. You still have the standard compliance requirements that you have in terms of diversification. You have a yield or a return basis that you want to maintain with your investors. And when you open up to multi-class without having something that is substantial to start the fund with, particularly a more frequently offered multi-class, you now give up the control you had in previous BDC forms of directing proceeds to particular investments. The proceeds are coming in effectively outside your control, so you could get a large number one month or one quarter, a small number the next quarter, and your portfolio team needs to manage their way through that in terms of the investments they make to align with their objectives. And so I think, at least from what we've heard, to help work through some of that, we have seen the single share class to start. Could just be a newness sort of thing going on in the market. It could be certainly to work through some of those conditions that emerge. We have seen that. And as such, really making sure that you're set to, number one, capture all the nuance associated with that initial share class, to think about some of the org cost requirements and thresholds that need to be met and how that may or may not affect later share classes, to think about the fees that are being calculated with those share classes, and really being able to set up the pipes, as I said earlier. So maybe while you have one active in the market, I can tell you, you're certainly working to establish those other ones in those couple of month kind of lead-in periods to ensure that you have the other ones up and running when it's time to hit go. And again, the other thing is just thinking about timing, and we haven't seen this yet, but we saw it in the earlier version of the non-traded products, just a real acceleration of timing. So whether it goes from quarterly to monthly to, a lot of those products ended up trading weekly in some cases. So being ready for something like that and having, your accruals ready, your calculations ready to really think about how you would handle that.
Right, and there's another piece of it that just, and it hasn't come into play yet because they haven't been around long enough, but 2310 does limit the amount of commissions you can have. So depending on how you've structured it, you may have to have a conversion into another class to make sure that you're below. So that's another calculation you've got to do to make sure you've got it under control. Right.
Yeah, there's certainly a lot of monitoring with the whole platform that needs to be done on a consistent basis. And I don't think this is a set it and forget it type platform.
So maybe just go on to liquidity issues, which obviously we've talked about them generically as non-traded, but the initial 1.0 had liquidity events attached to them, so very similar to the non-traded REITs. But it appears now that these are going for more a perpetually private product. Sean, can you give us any idea what the driving forces behind that are, or how people are getting comfortable with that?
Yeah. So I think it's pretty exciting just to step back and look at sort of the evolution of the BDCs generally. The innovation's been pretty remarkable, and it's what's driven, just massive adoption. Just BDCs, period, non-traded or otherwise, used to just be publicly traded. They would list, that was it. Then non-traded 1.0 came around, then private BDCs. Now you have multi-share class, and now you have perpetually private. And I mentioned earlier, we have 5 BDCs. One's publicly traded, 2 are private, 2 are non-traded. One of the non-traded is intended to have a liquidity event, one is not. And it's all around investor sort of choice and sort of what the access point of what you're trying to do, what you want it to look like. And so some people like public market vol, some people want it, some people don't. And ultimately what's driven, like we have a non-traded BDC that will be perpetually private. What drove it was our clients telling us, they want to access direct lending, but they don't want public market volatility today or tomorrow. They want their private market access to be private, and they're willing to allocate capital to a vehicle that they know full well is going to stay private. So, when the stock market trades up and down for reasons delinked from the underlying credit performance of your loans, they just don't want that exposure. And so that's really what's driving this. And then, I think that probably the next logical question is, well, are they in forever? You add other features like tender offers and the like. But generally it's investors looking at their portfolios and saying, what type of exposure do I want? And, developing the structure backwards from that and making sure that it fits. And so these perpetually private vehicles, for a smaller part of the portfolio, because they're very illiquid, but generally they're focused on taking out that public market beta.
Great, and you mentioned tender offers, but maybe if you can give a little more detail. I mean, BDC can do a tender offer, however, it does have to go through a fair bit of paperwork. How do you think of the tender offer or people's ability to get out of the product? Yeah,
it's an area where going back to sort of like the research and working with the home offices, it's the area of most focus, other than obviously the normal sort of your ability to invest consistent with your strategy, is this liquidity piece. Generally, what the non-traded BDCs have is some sort of quarterly tender. 2.5% to 5% of the NAV of the fund. It's not a redemption, it's a tender. There's a whole bunch of work and documentation and sort of regulation that goes around all of that you need to be very cognizant of, and your board has got to be really dialed into. But you have to set it in a way that you can actually deliver. That's the key of it all. Is you got to look at your assets, look at your balance sheet, and you have to size it in a way that you think none of these tenders are guaranteed. They're subject to board discretion, all the rest, but ultimately the practical reality is clients are looking at that as their liquidity for whatever the case may be. And so it comes down to portfolio and balance sheet management. Do you have the right assets? Do you have the right balance sheet? Do they match up with the liquidity that your investors are expecting? And that's something that you need to think very deeply about, because one, you should do it right. There's the road is littered with sort of liquidity mismatch between the assets and the investors. And then two, just make sure your board understands it, because if they don't understand it, then you're going to have big problems down the road. And if you don't, your clients are going to figure that out real quick as part of the diligence process, because there's been a whole host of firms that have done that poorly, and there's been firms that have done that well. And so you should be prepared to think very deeply about that piece. It's a core focus area.
But and the BDC structure does give you a little more flexibility or discretion than maybe an interval fund or something along those lines that has more dictates more requirements around what has to be sent out. So you have more discretion on how to do it, I guess.
Yeah, you get more flexibility and more discretion, but then you get more scrutiny from your clients as to how you exercising that discretion. So that's why you got to think long and hard about it.
So, Kristen, maybe you can talk a little bit about the transfer agent operational issues.
Yeah, I think James has already talked to us a bit about sort of the piping that goes on by the transfer agent in the background of the multi-class product. But is there anything else, James, that you want to tell us about the services that transfer agents provide in the multi-class structure?
So I guess I would just add, again, that it's emerging for BDCs and anything that would be unique there. But from our experience and what we're seeing now, what we expect to see from a transfer agent responsibility, it does follow the same requirements and guidelines as a multi-class, any other multi-class product. The tender offer process, as we were just talking about, does have some uniqueness, and our thoughts there are anytime you get into a tender offer process from a transfer agent perspective, really working with counsel, really working with the board to make sure dates and process is agreed to, documented, and worked through. There's a series of steps along the way in any tender offer process, and then subsequently, to the extent planning for situations which may occur where you have perhaps an oversubscription to the tender offer process, or having policies in place and procedures in place when you have a full an investor that wants to fully exit the product, and the transfer agent's responsibility for holding some of that back until the proper closure date, et cetera. So those processes we find are and expect to be very similar to many of the other multi-class products out there. I guess the other thing is we talked a lot about fees and really behind it the alignment of those differences between the different classes. I guess it goes without saying, but the transfer agent really has responsibility for maintaining those calculations and driving the difference between the different classes and understanding that and keeping track of it.
And James, you've obviously worked on a number of these. You've seen weekly and monthly closings. I guess at some point they were actually quarterly, but how does that interact with, coming up with the NAV and going through the process that BDCs have to go through? And is there any accounting or administrative considerations you have to think through?
Yeah, just to be clear on that, not on the multi-class BDCs. We haven't seen an acceleration of the timing. It's just sort of where, maybe where we could go next, or I guess anytime you get alignment of a structure with an investor base, you tend to hopefully see a lot of growth there, and we think this might be it. But no, Cynthia, to your question, I think it's really important to have clearly identified policies around valuation and NAV calculation and approvals by the board, et cetera, to be, to broad brush it, many of these investments are going to be private in nature across the space, private credit and generalization. So it's not something that you go out and obtain a market quote for instance, if we're talking about valuation, right? So you need to have a valuation policy that's set in anticipation of those more frequent NAV calculations, and there's plenty of, constituents in the community to work through that with your board, and how you would ultimately get comfort and give your investors comfort and your board comfort with how you came up with valuation. There's aspects of just keeping daily accruals. So, instead of thinking about something once a quarter, tracking all your fees, all your accruals on the investments, all your line of credit expense, ultimately on a daily basis, to get comfortable that day by day, on the 15th of the month or the 30th or the 29th, or as the case may be, you're ready to strike what the current net assets would be and make that determination for an offering price.
Great. Well, I think that hits some of the high points. I don't know if either Sean or James, you guys want to add one last thought before we go to close this out?
Well,
I would just add, oh, sorry, go ahead, Sean.
No, please go ahead, James.
I would just, add to what I was saying before. Super excited to see the growth of the industry, and I think, as Sean was saying, just the alignment that's been created on these products, and a couple trendsetters out there with the first few. But I guess our expectations are that many more will follow suit, and a lot of success for many members of the BDC community.
Sean, you get the last word.
I would just echo James. I think we're excited about the evolution and the innovation. Ultimately, it's all in the best interest of investors, and usually, if you look back, better things for investors tend to growth for the industry. So I think that's great for everyone. I would just add, I was taking notes. I mean, Kristen walked through the various requirements, and I know she was being brief because we've gone through them. And James was being brief about how it's a lot of work, and so you have to go in eyes wide open. They take a lot of work to put together up front, but even beyond that, these are operating companies, they're living, breathing organizations. You need to go in eyes wide open to have the right resources up front. As far as I could tell, most organizations looking at that understand that and doing a great job, and it's driving growth in the industry, and I think that's going to continue. We're super excited for it, to be a part of it, and obviously Evershed Sutherland has been driving that as well. So I would just thank you, Cynthia and Kristen, for your help there.
Well, thank you very much. It looks like the market is looking for more of these, and the clients are looking for this type of a product, and I'm glad that we now can bring it to them. So thank you for this afternoon, and thanks for participating.
Thanks, everyone.
Thank you for having me.